Probably not a bad time to check in on the technicals across the board in the markets. Join us now, Katie Stockton, Fairlead Strategies founder and CNBC contributor. People that don't even pay attention have heard about the 200-day moving average issue. It's an important indicator. It's not like magic. It just tells you, you know, here's where we've been trading for this period of time, and we're at a point now where those levels could be broken.
They're in play right now, the 200 days on sort of a widespread basis, and I see them as support.
You do?
Support or potential support. And part B, I mean, they're very widely followed, so therein they have importance, right? But they also tell us what the prevailing long-term trend is. So when you see them breached, of course, it suggests that we have something worse than just a corrective phase. But then I would guess also that maybe some of these algorithmic, like trading programs, have that 200-day,
right.
Becomes sort of a breakdown just by the nature of so many eyes being on that 200-day. So the 200-day does look vulnerable to us for the S&P 500, and we feel that that's a risk metric, and that the next support level, it's about 6 or 7 percentage points below,
which is significant. If we were to go, and
it
at
would
this
feel
point, you said you look at them as support. Does that mean you think they hold, or you think if they don't hold, it could be 6 to 7%?
Well, it's the right question to ask, right? Because for any kind of test of support, it's not like a precise level. So if it can kind of hang around there, that still could be a successful test. But if it breaks, that becomes the next support level that we would focus on. So a gauge of downside risk. Support doesn't act as a magnet per se, but it does frame what we could see on the downside. So it's really very helpful in that regard. But we use our indicators, things like the momentum gauges, to try to understand when we have a buying opportunity.
And there's more than just the S&P. There's the NDX and others. So nothing is good. You got nothing for me here that's good. So let's look within, instead of looking at the indices, look at some individual constituents. And that's even worse.
So what's happened is the former leadership, and which of course happened to be some of the biggest heavyweights and darlings of the market, now have long-term momentum sell signals. We're talking about Amazon, NVIDIA, Palantir, JP Morgan, AppLovin.
So all the biggies,
So a lot of the darlings are now in a position where either they're probably having entered trading ranges at best, or even bear cycles. So it doesn't bode well, of course, for us getting out of this corrective phase quickly. The correction does have different characteristics than early last year, in that, one, it's taking longer. It's gone from sort of a neutral range. It's now more of a grind on the downside, as opposed to something that's more swift, and that would be more likely a counter trend situation. The soonest that we could get buy signals from the counter trend indicators that we track is in about 2 weeks. So what we're going to try to do is just try to time short-term entries and exits within this context.
I wonder if that lines up with fundamentals, the war, everything else. It's weird the way it does sometimes.
It could also just be simply it's a mature bull market. I mean, the last push higher has had less momentum than back in 2024.
Point out Micron. Sure, it didn't act well, but it had broken out to new highs that were in the stratosphere, based historically from where it had been. So it does call into question the new high breakout, but it's not like the end of the world for where it had been.
As a short-term development, the gap down yesterday was definitely bad, because it
for the semis too.
For the broader semiconductor complex, especially, SanDisk is another one that has been another darling of the market. Semis as a group have not broken support. We've seen breakdowns, of course, on a widespread basis, but semis have held up pretty well, even though breadth has contracted. When we lose the support of that leadership from the semiconductor sector, that could be problematic, of course, and lead to maybe that next leg lower for the market.
You're still looking at crude like a technician. I mean, what good are technicals when something like a war can close the Strait of Hormuz, and it has nothing to do with support, resistance, but yet you still try to. So tell us. But you're saying the upside momentum has been broken at this point?
Well, if you recall back in January, we were constructive on crude oil from a technical perspective, meaning we think it'd go higher. And that was in part because the downdraft started to generate counter-trend signals. So even before the war, we had signs of downside exhaustion. And now we have a momentum shift. So, you see NVIDIA lose the support of long-term momentum. Crude oil has gained it. So that same monthly MACD indicator that we tracked is now positive for crude, meaning that while this is probably overdone perhaps in the short term, that the trend now has asserted itself as being an uptrend. So it's a big shift, and we're seeing it in other commodities as well. I'd expand that to some of the agricultural commodities, look at the turnarounds underway, perhaps in corn and wheat. So it's pretty interesting.
But to Joe's point, that's all tied to the macro, too, when you can't get fertilizer through the strait.
But there were early indications of it from the chart. So,
Weird. So what's the good news?
I know.
What's the good news? Anything you want to be optimistic about on this Friday morning?
No, not Bitcoin.
I actually think that Treasuries will do okay. So I don't think not that that's the most exciting
trade,
news.
Okay.
The
Yields are going to
trade. Well, and eventually I think
430
is like
is the high, right? On the
We're there.
It is a resistance level for yields. But
What happens if it pushes higher than that?
well, that would be a breakout because the 4.3 to about 4.33 area for the 10-year is a big hurdle. If you look at credit spreads, it's pretty interesting. If we see a bit more widening, then we'll have a breakout in credit spreads, which of course would be an equity market negative. But when I look at Treasuries, and I make a comparison back to 22, so if, let's say, we were to get into a prolonged range or bear cycle for equities, I don't think we're going to see the high correlations between Treasuries and equities that we did back then.
And I'm just going to summarize your Bitcoin viewpoint since they want us to get out of this. Short-term stabilization within a cyclical downtrend. Too early to suggest we've bottomed, but we may be bottoming. And 57,800 is the possible low.
But
in the range, almost just under 80,000 for.
there's some resistance there, and we just would wait for the cycle to show signs of downside exhaustion, and that could take months.